Okay, well, on behalf of MBA Investment Bankers LLC, I'd like to thank you guys for the opportunity to be here, and we apologize for the delay. We just wanted to evaluate the company and to analyze a lot of different factors and help advise you guys on what we think is the best route in providing liquidity and the next steps for your company. So beginning today will be Max.
Us three are the managing partners of the company, and also Raul, but he couldn't be here today. So she's Amanda, like she said. This is Kevin, and my name's Max. The agenda for today is to basically go over the whole overview of the company and the offer that Audubon gave you guys. Let you know the evaluation methods we use to value your company, and then give you some alternatives, and then what you can do, and then one that we recommend to you guys. And then at the end we'll have time for questions, but if you have any during our presentation, you can feel free to ask. So as you know, you received the offer of $160 million for Audubon, and they're mostly interested in the synergies of your European sector, and you were not too impressed with the offer, and we were not either, because we feel that your company is valued at a lot more than $160 million. And we will show you why we think that and the methods we use to come up with those figures. So Audubon is they're located in Germany, and like I said again, they're only really interested in our European portion, not so much United States. As auto industry right now in the United States is in recovery because the economy is improving, so there's a lot more credit available to buyers. And a lot of the cars are, well, median age is over a decade old, so people are starting to get more and more new cars because theirs are getting old. In Europe, it's kind of the opposite. It hasn't really recovered to pre-2009 levels because of the recession, and it looks it's not improving at the moment. As far as mergers and acquisitions activity in the United States, there's not a lot of deals going on, but there are some active buyers, and for the blue sky valuation method, we use multiples of 5 and 7. For Europe, it was lower because the auto industry isn't doing as well. As far as acquisitions in Europe, there's a lot of companies looking to merge and consolidate just so they can save in the longer run. And I'll give it out to Kevin.
Thank you. So to evaluate your company, first and foremost, we went with the blue sky method because that is the industry norm for car dealerships in providing the best total value. So basically you take the net tangible asset value and you add it to the franchise and goodwill value. So basically we took the net tangible assets minus liabilities, but we also factored in the market value of the real estate, which is 10.4% higher in Europe and 8.2 million higher in America. As well as non-recurring expenses, we took that out of liabilities because that will not be a factor moving forward. And the LIFO reserve, we also factored into both additional inventory as well as after-tax profit for the income statement. So we used the 5 to 7 multiplier because we have a luxury car brand, and that is the industry norm in America for that. So base here we have the multiples for Europe and US. US is listed first, so we have 5, 6, and 7 on this side, and the different multiples on this side of Europe. We settled on 7 and 4 as the two to value the company at, because in the US, although we don't have the highest sales, we are a luxury company, so we can make up for that factor. And since the economy is improving and the auto industry is bound for recovery, we decided to take the highest multiple possible. And in Europe, we were considering to use 3, but based on the synergy benefit, we decided to go with 4 because we feel companies could be willing to pay more for that. And for the control premiums, we took the last 90-day average as opposed to doing it individually with the international average or the domestic median or any permutation thereof. So once we did that, we settled on a final valuation of $193 million. So that is $33 million higher than the proposed offer, which is why we feel at this point we should not accept the preliminary offer. In addition to this, we did the free cash flow valuation. Basically, we did the terminal growth rate of 3.69% and a weighted average cost of capital of 11.07. You can find the components of which in the back of the PowerPoint slides. and we used a tax rate of 35%, and that's left us at $192.8 million, which again is very similar to our blue sky valuation. And then we also did comparables just to see how we rank in the industry. We had pretty similar PE ratios to Group 1 Automotive and Penske. We compared to these because they had US and international operations, so we felt that they were most comparable. Our PEG ratio was right at 1.01, which is great because it says that it's a fair valuation of our company. We're not undervalued or overvalued based on our valuation. So I'll leave it to Amanda now to take you through some of the potential options.
So going through and using the numbers from these valuations that we just went over, we've kind of predicted and come up with different options for you guys to take, and then at the end we'll give our final recommendation as to what would give you guys the best liquidity and for the best value of your company. We'll start with option 1, which is to accept or reject the initial offer of $160 million from Autobahn. We have option 2, which would be to counter offer or to potentially find another buyer who may be able to offer more money. A leverage recapitalization would be option number 3. Option 4 would be to sell just the European sector, since Autobahn may be interested in this due to the synergies that they initially made the offer for. And then option 5, a strategic partnership with just the European operations. And then also option 6, which was the ground lease back. So looking at option 1, the pros and cons of rejecting Autobahn's offer. The pros obviously would be your initial liquidity. You have a buyer right there, so it would happen almost right away. You wouldn't have to look for anyone else. But the reason why we decided not to do that, obviously, is because we evaluated the company, your company, higher substantially with about $30 million more. So we believe that this would not be the best route to go. With the counter proposal, we could potentially go with them to, or go to Autobahn with our evaluation saying, you know, we valued at around 190 million to 195 million, and we believe that we should have a higher offer from you guys. We decided not to go through with this, however, for the fact that they could simply walk away, and also with the market is the way that it is, we don't know if we can get the offer that we would want. With a leverage recapitalization, this would be just taking on more debt in order to make money and provide that initial liquidity that you guys are looking for. We currently have debt of $60 million, and using the industry average, we could take about $87 million with debt, so that provides us an additional $27 million that we could take out. However, looking at the cons, you can see that we already have a low profit margin in this industry, and it's also less attractive for acquisition in the future because of the amount of debt that we would have, and this also changes your future valuation as well. So we decided not to go through with this option. Looking at selling just the European options only, this would be selling the European sector and keeping the American sector as is. This would be initially really good because you guys would get some liquidity. However, it's not as much as desired. The European is currently valued at $61 million, so that would be the liquidity. The reason why we did not decide that this would be the best option for you guys is because the market is still in recovery in Europe, and you may potentially be able to get a higher offer in Europe in the years to come. And also, we do not know the sovereign risk that they have there, as well as the diversification risk, and that we would need to go actually into Europe and evaluate the operations even further in that country to make sure that this is the right route to go. Looking at the strategic European partnership, this would just be the partnership of the European operations with either Autobahn or some other company in Europe. The pros to this obviously would be stronger inorganic growth, which provides diversification. However, again, sovereign risk is an issue, and it does not give the liquidity that you guys are looking for initially. So going to Kevin, he's going to explain the ground lease back.
So the ground lease, basically, in layman's terms, it is where you value your land, and we have very expensive land in this case because we have premium locations throughout California. And you sell it immediately, so you get that upfront liquidity, and then you amortize that based on 12-year straight line payback. So from this, we took 80% of your PPP or PP&E to get the building and land value, and since it is a premium location, we took 70 to 80% of that to get the assumed land value. From there, that generated $21.45 million in upfront liquidity for you. That also, however, adds $3.5 million per year in added expense. So that changed the valuation, lowered it down to 177. So we felt that this lower valuation did not make up for the initial liquidity that you'd be receiving up front. So our final recommendation is that we think we should go public at this point. We have a very high market cap, and based on the different share possibilities, we recommended to go 10 million shares for an per share average of 19.32. This is right around the industry average there, so it's a good place to start at, and we can grow from there. We just feel that it's a very difficult market right now for private equity consolidations and acquisitions, but it's a very good market for IPOs right now. People are going public and they're seeing great valuations in a company going forward. And most importantly, this provides total freedom for you guys to liquidate or diversify as you see fit, and to go into different asset holdings based on however you desire. However, this does bring about 3 to 10% in expenses basing on how long it goes. Average is 6 to 9 months if we do it properly to go public. This means that everything has to go flawlessly, and you have a great company, so we don't feel that that should be a big issue. So we went towards the lower end of around $6 million for expenses, but we feel that the capital gains and dividends that we could pay out would more than make up for that. So just to summarize, the pros are we can gain access to capital markets, especially for Europe, because we are pretty cash poor in Europe at this point. So if we're able to get some new operations going, we can take advantage of the low price of everything right now and appreciate going forward. Also, this creates liquidity for you to do whatever you want with the company. It gives us a better public profile and makes us more well-known. It improves our efficiencies and gives us better debt finance terms, which is very important in the auto industry because you already have very high debt rates. The cons are obviously it could become a protracted process and it could have potentially high fees, but I believe that we have a great company here and it should not be an issue.
Is there a question in the back?
No, that was your 5 minutes.
Okay, thank you.
One of the bigger cons is double taxation. You are taxed at the corporate level as well as the dividend level. But we believe that based on the appreciation of the share price over time, that should make up for it as well. And there's more compliance and responsibility issues, but again, it's a great company here, and we don't believe that that should outweigh the numerous pros that we are getting from this.
From a market cap perspective, I mean, it's $200 million. I mean, that seems awfully small in the public markets.
Yeah, we did compare based on the other companies. What we were confident in is that we have a luxury brand, and we feel that if we are able to get more operations going once we do have a cash infusion, we could grow substantially from that because sales are obviously lower since we have a higher quality product. But once we have more operations going through expansion, I feel we can get a higher value.
And also elaborating on that, if you do the total capitalization per location, ours is actually higher than some of the leading competitors in our industry. So as per location basis, maybe when we go public, we can use some of that funding to expand our company, and we are confident that this would be the best route to go.
What would be some of the other additional expenses we may incur as a public company that we wouldn't incur as a private company?
Obviously, there's compliance fees. It's just beginning the process. You have to register with SEC. You have to do the whole auditing of everything. But again, we said that should probably come out to 3 to 10% initially, just going through the IPO process. But then there's additional silos of operation you probably will have to incur just for compliance reasons. So,
question around the activity level for a company this size coming out and doing an IPO. Do you think this is going to be a closely held company at the end of the day, or will it be heavily traded? What's your read on that?
Honestly, that's kind of where we were leaving it up to you guys to determine. It can be closely held. You can maintain majority ownership, or you can diversify as you see fit. That's what honestly why we felt this was one of the better options, is because it gives you total freedom going forward to sell now, sell part of it now, sell part of it later, just however you see fit.
In going out and doing an IPO, would we maintain the same, approximately the same kind of debt level in the company going forward?
The debt level would go up a little bit because of those initial fees to start as a public company. and using those and incorporating them into the statements, yes, we will have a higher amount of debt. However, we cannot predict how much of that will be subsidized by the profits that we would get from going public. So, I mean, it's something that you can see as you go. However, for the small amount of debt, it would be, because we're such a small company, going public is going to be a little bit easier. And that's why we feel we're more comfortable with this option, and the debt really doesn't seem that much of an issue to us.
And because based on the industry average, our debt level is about 20% lower. So we do have room for additional debt if need be.
Can you explain the double taxation that you were talking about?
Yeah, you are taxed at a corporate level based on the company, and then if you do want to sell your shares, you also tax on that at the personal level. So
would we be issuing new shares, or would we be selling our own shares?
Selling your own shares, most likely.
We would get double taxed on that?
Well, to elaborate on that, we would automatically get taxed as a corporation when we go public. And then any of your capital gains that you would have from selling those shares, or any dividends that you would receive, those are obviously taxed at the individual level as well. And that's why we were kind of saying that might be a disadvantage if you kept or retained part of your ownership and then you were to sell it all at once at maybe a higher price than the initial IPO, you would be taxed twice on that.
What analysis have you done to come to a conclusion that U.S. IPO markets are in fact friendly to companies like us?
We were just going based on the recent trends, especially in real estate. Companies like Trulia and others of that nature have gone public recently, and there's kind of just been a feeding frenzy. And since we are not necessarily attached to real estate, but since we do have high land values, we kind of looked at that regard. But just...
Do you have any statistics on any of your slides?
No, we do not.
Okay.
Thank you.
Thank you very much.
Thank you, guys.